Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more information about education and resources, please visit adisa.org and check out the resource library. I'm your host, Greg Mausz, and today I have Fred Baerenz. He is the CEO of the AOG Institutional Diversified Fund. Thank you for joining me.
Good to be here, Greg.
So we're talking alternative investments, which is things that are not stocks, bonds, cash, or funds or ETFs made from those. And there's been a lot of growing use of alts among financial advisors and clients, but there's still a lot of people that aren't using it. Why do you think that is?
Well, just the word alternative. I've tried for years with our association and others. It's so embedded in the SEC and FINRA that we're not going to get rid of that word. So I think it should be more mainstream than it is, and it's actually becoming more mainstream. In the past, it was largely the domain of ultra-high net worth investors and institutional investors, and the average advisor, average investor really didn't delve into it. But now with the really poor performance of 60-40 this year, some have speculated that that's been a bad idea for quite a while. Now people are more open to looking into it and are beginning to explore the additional asset classes.
Good. So let's get nitty-gritty. How do you apply alts to a portfolio?
So our firm has managed an endowment-style model for more than 20 years. And so we've been utilizing commercial real estate, private equity, private credit, some hedging strategies for decades now. And so we've been able to plug in and be able to find the firms and find the funds that we need to implement that model.
That's really fascinating, but you threw out some sophisticated strategies there. Those are normally only available to qualified purchasers, big family office institutions. Is that available to the retail, mass affluent investor?
So you're right. It's probably been the last 10 to 15 years, the last probably 7 or 8 years, when the major institutions have found a way to bridge the gap from institutions to retail investors. And in my opinion, the delivery vehicles are getting better and better all the time. So, it used to be you had to be at least an accredited investor to access some of these items, which is $1 million or more of investable assets. In many cases, you had to be a qualified purchaser, $5 million or more of investable assets. And the vehicles are getting better and better such that these very sophisticated strategies are now available, at least in accredited investors, if not just the general mass affluent.
Well, since institutions have been using alts for now decades successfully, what type of best practices or lessons learned can we take from institutions and apply them to the retail investor?
So it really centers around two key phrases. There's the illiquidity premium, the idea of you have two management teams, one that has to report to the stockholders every 90 days versus somebody who's got 3 to 5 years in order to produce a change in a company. And so that second management team, with that advantage of having illiquidity, they don't have to give the money back right away, can typically produce better outcomes. So you have the illiquidity premium on the one hand. On the other hand, many advisors and investors consider any illiquidity just risk, 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 which in fact, used properly, it can actually de-risk a portfolio.
You're right. And from some of the stuff I've been reading lately, investors actually have quite a long time horizon. I believe the stat is that if there's a married couple and they are both kind of healthy at 65, there's a 50% chance one of them is going to be alive after 90. So even at 65, that's a 25, 30-year time horizon where you can ride through cycles, ride through liquidity events and things like that. So I agree with you that, having some investments that have illiquidity can be a win.
Well, and in fact, hopefully all financial advisors are actually doing a financial plan. And so as you test out the past investment behavior, timelines and horizons, whether they have pension, Social Security, some other form of retirement, most of my clients actually have an appetite for a significant portion of their portfolio being relatively illiquid. And so it actually works in favor. And in fact, some of these structures are bringing more and more liquidity all the time.
Talk us through more liquidity, or how do you stage liquidity in portfolios?
So typically, with the interval fund structure, for example, let's start basically with REITs. That's probably a better place to start. In the old days, if you got into a real estate trust fund, non-traded, you could get your income along the way. But if you wanted your principal back or your profits, you had to wait until the fund either listed or was sold, which sometimes, typically would be an average of 5 to 7 years, sometimes sooner, unfortunately, sometimes longer. With the interval fund structure, that attempts to provide 5% liquidity each quarter, but that also produces the cash drag. If you have a great investment thesis that you love, for example, commercial real estate, private equity, private credit, you don't want to have 5, 10, 15% of the portfolio hanging around just in case somebody wants to get out and not invested in that great thesis. So there's yet another innovation coming through NASDAQ. NASDAQ has what they used to call the auction fund, and still call that with the SEC, but they're describing it more as an exit strategy. So the idea is you get in when you're ready to do that. If the fund goes up and you want to get out, you collect your income along the way, you get your principal, and you get your profits. And it's much more efficient than the preceding vehicles.
Interesting. I look forward to learning more about that as that market develops.
You'll be among the first to hear about it.
So real estate is probably the most commonly used diversifier or alternative investments. So why is real estate the most common, and how does adding that to the portfolio really help reduce volatility?
Well, honestly, for the new financial advisor or new client coming up to real estate, I mean, first of all, 2/3 of the country owns their own home. So they have some experience. Now, that's not what we would call, generally institutional quality real estate, although there's now some funds that are buying single-family homes. But they have some background in it. So they understand that markets can go up and down, that you want to hold it for a while, that there's some tax efficiency, that there's a nice income stream. But unfortunately, many advisors and investors, when they approach this, will try to approach it by buying a traded REIT, which there are times to own those and there's times not to. So for example, in the graphic that's shown, it looks a little bit like the Golden Gate Bridge. But you see over the last 40 years, there's only been 4 years when institutional real estate was down. The first was following the savings and loan crisis, which was really a financial issue in the early 90s. The second was during the Great Recession. So typically when our financial system is under grave attack, that's when you'll see commercial real estate dip. So the next slide will show you the S&P 500. And you can see the volatility. Both asset classes average in the 8 to 10% range. But you can see from the graph, there's far more volatility with the S&P. Well, then you lay in traded real estate trust funds. And again, we use both. And while you're trying to diversify a portfolio and have non-correlation or a dampening effect, less volatility, the traded REIT doesn't do that for you. It's very helpful at times, but you need non-traded real estate to really dampen that volatility. So that's the last graph, which is represented by NCREIF, which is commercial real estate institutional funds.
And I think real estate's a great starting point, but I'm also seeing rises in debt funds and debt strategies and private equity. Are those also available for retail investors?
Absolutely. And with private equity, it's really fascinating because many of us remember the 90s and the go-go days of the dot-com boom and then the dot-com bust. But frankly, some really cool companies went public back in the 90s, things like Facebook and Yahoo. But they typically had to, because in order to get the early investors out, the friends and family, that was the only choice they had. So typically a private equity fund would go public in about 4 years. Now, because there's so much money available, the typical private company doesn't go public for about 14 years. And while there's still a premium after buying an IPO, there was a lot more meat on the bone 20 years ago when you could access private equity after about 4 years, and so kind of catch that wave. So now, in order to get that private equity premium, if you will, you have to get in earlier. You can't wait for the IPO and then benefit. You have to go into actual private equity vehicles.
Right. So Fred, I've been reading a lot of research about endowments and how they're using alternative investments and have put up some amazing numbers. Can you touch on that?
Yeah, so Dave Swenson took over the Yale Endowment Fund in '86 and wrote his first book in '93, which I read while I was doing my training, and that heavily influenced me. I thought, if he can do this for Yale and other endowment funds are doing the same, what if I could do this for regular clients? But even within the endowment world of universities, there's a big disparity between the haves and have-nots, if you will. The graph that you can see on the screen now shows that the small universities that have endowment funds, say under $100 million, don't have the same bandwidth, they don't have the same talent to be able to pursue these strategies. And gradually, as endowments get larger and larger, their allocation to alternative investments also gets larger and larger, which also helps their performance. And this graph is as true for last year as it was on the last 10 years and the last 20 years. So even with the university endowment, there are the people that are a little bit better at this and they're not so good at this. The same thing will be true with financial advisors and frankly with clients.
So Fred, thank you for sharing the thoughts on why more people should be using alternative investments.
Thanks for having me here.
And thank you for watching. For more information about everything alternative investments, please visit adisa.org. Thank you.